Welcome back to Schwab Impact here at the Colorado Convention Center. Interest rates, they've been rising since Fed Chair Powell's more hawkish comments during last week's news conference. Kathy Jones is Schwab's chief fixed income strategist and joins us now. It's good to see you.
Hi, Scott.
What do you make of the backup in rates?
You know, I think the market just got way over its skis and expectations for Fed easing. I'm not really sure why, because the data weren't really that compelling. But now, we're back to kind of an equilibrium where we're anticipating, a couple of rate cuts next year, and got the long end hanging out in its usual 10 years, hanging out about 4.10, where it's been for quite some time.
I know, but we were below 4% on the 10-year. We're up, more than 15 basis points. And you think it's directly a result of what was unequivocally a more hawkish Powell?
Oh, yeah, absolutely. I think the market expected Powell to come out and say, okay, we did this cut, and now we're going to keep cutting. And that was definitely not the message.
What do you think? Do you think there's any tariff Supreme Court risk in the curve?
I don't think so, because the amount of tariff revenue, if you want to call it that, is pretty small relative to the size of the deficit, the size of the economy. So I don't think it's going to have a big impact that way.
It seems like, from what I know you like in the market, if you were going to recommend tips, for example, to investors, do you think the risk is to the upside on inflation from here?
Well, part of it is the valuation of tips right now. If you buy them, you have a positive real return. So part of it is just the math works out. It's indexed to inflation, you get that positive real return. The second thing, though, is I think there is more upside risk to inflation than downside, at least for the next 6 to 12 months. Beyond that, we'll have to see. But I think that there's enough risk that it warrants having some exposure to tips.
What do you think the Fed does into 26? I mean, first of all, do you think December gets another rate cut?
No, I don't think so. No.
And what about as we turn the calendar?
Yeah, it's going to depend on if we get data. It's going to depend on how the data turn out. I think a couple of rate cuts in 2026. I think they're going to take their time, take it slow, look at how things are playing out. But there's room to cut one or two more times. But after that, unless inflation really comes down, you're getting the policy rate and the inflation rate right on top of each other. There's not much room to maneuver.
What is most exciting to you today in fixed income?
I guess it's exciting that it's not exciting. So there's enough excitement in all the other markets, enough volatility, enough turmoil. Got very, very solid returns. So you're looking at very positive returns in every sub-asset class. International bonds have produced, 9.5% total return year to date. That's been very attractive. I don't know we can repeat it next year, but I think there's, for the first time in 15 years, there's probably an opportunity to be invested in international bonds.
It's funny, there are some that I've interviewed lately who agree with that the international credit markets, bond markets are more attractive than ours right now. Europe, maybe emerging markets as well. And you agree?
Yeah, I don't know they're more attractive, but I think that there's some opportunity there. And it's been such a long stretch when that really didn't look good for a U.S. dollar-based investor. And now we have a less strong dollar. That's going to help a lot.
Quickly, too, high yield, yes or no?
Cautious. So high yield, as we look at it, is less junky than it used to be. I'm more worried about the leveraged loan market and some of the really low quality stuff.